us now to weigh in on all of it. We also have our own Steve Leisman, of course, joining us at Post 9 as well. Good morning to both of you. So, President Barkin, first impressions, looks like a pretty weak jobs report. What do you think?
Well, I've been saying that there's been this disconnect between the data we're seeing and what I'm hearing on the ground, and I really do believe in listening to what I'm hearing in the economy. What I've been hearing is normalizing. Labor market in better balance, supply's been getting better, demand's coming off, particularly in places like professionals. It's still hot in skilled trades. You still hear a lot of heat in skilled trades, but I wasn't surprised. Frankly, it was welcome to see that the gradual lessening that we've been expecting is continuing.
So does that mean you can be done raising rates?
Well, you went right to it, didn't you, Sarah? No,
That's the question.
I'm not going to prejudge that. I value the optionality of seeing what we're going to see in the data, and in particular, we're going to get 2 inflation reports between now and the next meeting, and I think that's what's going to matter to me.
Well, it feels like you guys want to be done. Like you feel like you've done enough, right? And you want to see it manifest in the economy. Is that accurate?
What I'd say is we want to be done with inflation, but you want to trust that, but you want to verify that. So I'd very much like to see inflation continuing to come down. That's what I'm focused on.
Tom, I get to ask the Fed chair one question. So you have the opportunity here to answer the second question I would have asked him, which is, at least in the wake of the meeting, and certainly even before the meeting, the market has begun to price out an additional rate hike. Are you comfortable with how the market is priced in that regard, in the sense that, are you afraid you're losing optionality to come back and hike again?
Well, I'd like to think the market's responded to the data. And so what we saw today was data that showed a gradual lessening of the job market. I think that's what those who would like to not see another rate hike would want to see. We'll see what the inflation comes in. And if the inflation comes in relatively hot, the market will react, I'm sure.
If it does come in hot, this idea of doing one more quarter point, it seems almost superfluous, right? I mean, if you have inflation that remains high, another quarter point ain't going to fix it, is it?
Well, you could say that about every one of the things we do. Does 25 basis points matter or not? I do think the notion of expectations matters a ton. And if you're going to not respond to inflation when it shows elevated, I think expectations will respond to that. And so I'm not sure 25 basis points in the end is the answer to all the world's problems. But I do think if you're going to take care of inflation, you've got to respond if it shows up.
You want inflation to be over. How will you know when to declare victory? So we're at, what, almost 4% on core inflation. You want it to be at 2%. You're not going to wait all the way till it goes down to 2% till you say you're done, right?
Well, I'm focused very much at this point of trying to understand the behaviors of price setters. And if you go back to 20, 30 years, price setters have been beaten up by the combination of e-commerce, globalization, access to new supply, and the power of big box retailers. And if you go to 2018, 2019, you talk to those folks, you found people who really weren't into raising prices, didn't think they had the power to it. I'm out there talking to price setters now, and there are some who've taken a step back and said, okay, we're on the backside of this. Apparel would be a good example of that. But I still do talk to price setters who are looking to get more price. Look at the big consumer products manufacturers. They're interesting to look at their earnings. 2019, 2018, price up 1 or 2%, volume up 1 or 2%. In the midst of the inflation area, price up 12, 13, 18%, volume pretty steady. You're still seeing price of those big manufacturers up 7, 8, 9, 10%. Volume's starting to come off, but I'm looking for the point where they're no longer taking outsized price increases because they're worried the volume in the market won't sustain it.
What are you saying? Let's say you're at a dinner party, and I can't remember a dinner party where real estate didn't come up. Are you roundly hated because of what's happening in the mortgage market right now? And do you think it's gone too far in terms of 8% mortgages? Are you leaning too hard now on the housing market?
Well, I go to dinner parties with old people, and old people say, I remember when I used to pay X% for a mortgage. That's the world of dinner parties I go into. I think the housing market, there are a set of people who do want to buy into a house. I do think they're increasingly frustrated by lack of access. I think the home builders, the big home builders, are still building at scale, and so there are markets of mine, like North Carolina, where you're still seeing a lot of home construction. But in the places where you're not seeing it, you not see that frustration. I think the broader commercial real estate market is the place where they're not throwing me any parties right now, and there's a lot of noise in that market.
Tom, dig a little more into when I follow you, what's really interesting is you lean less on the econometrics and more on what you're hearing and how business works, and your ideas about price setters and how they think culturally about it. It's a time to raise prices. Give us more of the anecdotes you're hearing about. How weak do you think the economy might become here from what you're hearing from your business context?
So what I'm hearing from those who sell to lower-income consumers is lower-income consumers are reprioritizing. They're making choices. Importantly, they're not out of the market. They're still spending, but they're absolutely reprioritizing where they spend and how they spend. You hear a lot about discretionary versus non-discretionary. I'm hearing increasingly over the last 3 months more news of middle-income consumers trading down. If you look at Walmart, they had that in their press conference. And so the wealthy are the ones who are still spending. I think even the wealthy are backing off of goods. They're still spending, extravagantly, if you will, on services. And so that's what's really keeping the economy going on the high end. Now, we're seeing consumer spending data that's much stronger than what I just described. And so that's the disconnect that I talked about at the beginning. I still think there's a good chance that what we're seeing on the consumer side is a normal economy, a solid economy, not a frothy economy that would be implied by the recent retail sales or consumer spending. But we'll see. I mean, the data will get updated and we'll get more data and we'll see what it looks like.
Have you been impressed by some of the productivity data? And is it changing the way you're thinking about the economy's ability to grow without inflation overheating?
Really pleased by the recent productivity data. Really unhappy about last year's productivity data. You can't, in this era where people left work in low-paid professions and then came back, you can't look at it anything other than a 4-year basis. If you look at productivity over 4 years, it's basically where it was in 2018, 2019. It's a tick better than it was in 2013, 2015. I hope it continues. There's lots of reasons to think it might, as people figure out how to do more with less. But we'll have to see whether it continues.
Do you think it's related to AI, even at these early innings?
I think it's too early to give credit to AI. But I would give credit to people in a tight labor market innovating and thinking about how to deliver for their customers with somewhat fewer workers.
You briefly mentioned commercial real estate, at least as being, you seem to indicate, and as we all know, a potential problem. I'd just like to get a little bit more from you on that. How big a problem do you see it? I think 2/3 of commercial real estate loans are actually fixed rates, so with the 10-year moving a little down in yield, this a bit of relief. But overall, what are your expectations there?
Well, you have to take commercial real estate apart, and so industrial's doing fine, and retail's actually doing
right. It's
okay.
Office that obviously is under the most pressure.
Office and really B and C downtown office where people aren't going back to work, and I do think that's a troubled sector. It's a bit of a slow-moving train because individual owners have choices as to, when to sell and how to sell or give it back to the bank or not. But everyone I talk to, from banks to real estate things, think that's a segment that's going to go through a set of challenges.
Banks don't want it back if they can avoid it.
I don't think they ever have.
No.
Right? And so there's a set of challenges that we're going to go through there. I don't think this is an unknown challenge. We've had commercial real estate things before. The banks, I hope and expect, have the capital to get to the other side of this.
So you will be a voter next year
Yes.
on the committee. How are you going to determine when to cut rates?
Seems like that's still a ways off in my mind. But what I'm looking for in the first instance is for inflation to settle. And so I like it when you can get the 3-month, 6-month below the 12-month, as has been happening. I like it when that continues down, and I hope and expect we'll make continued progress on that next year. Demand matters as well. If you see really vibrant demand, it's hard to make the case that that vibrant demand is helping inflation slow. So that's another thing to watch on. You could imagine scenarios where demand comes off and you have to do something. You could imagine scenarios where inflation starts to settle and you want to lower real rates. Both of those imaginary things still feel pretty far out in the distance to me.
When it comes to lower rates, I'd just love you to respond to something we heard earlier this week on CNBC from Jeffrey Gundlach of Double Line Capital. He's one of the more important voices in the bond market. He basically posited a thought that the Fed is ultimately going to be forced to lower rates because to do otherwise, given the refinancing needs of the U.S. government, we're going to be running $2 trillion interest costs within 3 years. Is that a real factor that you think about?
I think we're just trying to get inflation under control. I'm not spending time thinking about government.
At all. So it is possible, therefore, if rates were to stay high, that the U.S. government's budget would be basically eaten up by interest costs.
I think the size of the deficits we have now is something that's getting a lot of attention and should get a lot of attention. And of course, if you reduce them, you'll reduce the interest costs. But we'll see what the various legislators choose to do with that.
Tom, when we do our Fed survey, we did a grading of Powell this time around. and we asked people to grade him on different things, and he got a D in economic forecasting. You guys missed the inflation on the upside in terms of how you ran policy. Is there a reason to have any confidence now that you're going to get it right on the other side?
Well, I'm hopeful you don't do a grading after this show, and I'm curious what my grades are.
I think you're doing very well right now, but we'll judge you later, right? I mean,
I do think if you look at my forecasting, I'll just talk about myself, I didn't see inflation persisting for nearly as long as it's persisted. I did see the risk of a volatile market around the reopening of the economy, but I mean, I thought that this would settle more quickly too. So I'll take, my share of that grade. And I think pretty much around the world, people had that. That's an important question. Why is it that we collectively as forecasters didn't see inflation persisting? And I think it has to do with, the way one thinks when it hasn't been there for 30 years, right? And so the sense that expectations would settle so quickly. What I believe, going back to what I said before, is that there were price setters out there who didn't think raising price was a lever. If you're a business, though, raising price is your most valuable lever. It's the quickest way to make money as long as your customers don't go away. And so I think all of a sudden it became clear to price setters that they could do something, and they're not going to give that back without competitors or customers, forcing them to do that. And so on the other side, I'm trying to pay attention to these same people. And what I'm hearing is it's going to take a while for them to come back to the behaviors pre-COVID.
And is the 10-year yield doing your work for you?
Financial conditions help do what we're trying to do. We try to, through our rate moves, affect the financial conditions. Financial conditions affect the economy. So long as financial conditions are affecting the economy in a direction that takes us in the right way, that helps. But it's not really a policy variable. They're pretty volatile. We don't control it.
Yellen took some incoming this week from Stanley Druckenmiller for not issuing more long duration when rates were lower. She responded last night by saying that actually portfolio duration is the longest it's been in decades. Do you take a side on that debate?
I'm pretty clearly not going to take a side on that.
Do you think we've seen the highs in rates?
I don't know which rates you're talking about, but
Fed's interest rate and market interest rate.
I don't know.
I'm just asking in a different way.
Yeah, okay, no. It depends to me exactly on what happens to inflation. And I'm watching that closely, and I'm very hopeful that we're nearing the point where we can get it under control, but the markets will tell us that.
Is there a big disagreement inside the Fed right now between those that are worried about inflation sticking around longer and having to potentially do more and those that feel like they're done?
The great thing about our committee is you get a lot of views at the table and people take those. I think it's a consensus-oriented committee, though, as you've seen from the votes over the last couple of years. And so everyone puts their view on the table. We kind of work it out. And I think we've so far been able to come to a pretty strong consensus.
Let me ask it another way. This is a great question that Sarah asked, which is, do you have to be convinced to hike, or do you have to be convinced not to hike?
I don't prejudge the answer, as you know. We've got a meeting in 6 weeks. I think we just got out of the last meeting. And so, I'm saying we got out of the last meeting. Let's get 2 jobs reports. Let's get 2 inflation reports. Let's get a consumer spending report. Let's see if the things that I think I believe today are still true or not. And so I think we've got a lot of time.
All right, one more way. Is there a big risk of over-tightening or under-tightening right now?
They're both big risks.
They're both big risks.
Sure. And by the way,
there's
there's also a risk that some boulder comes in from left field and takes on the economy in the way that the pandemic did. And so you're always dealing with under-tightening risk, you're always dealing with over-tightening risk, and you're always dealing with the risk that perfect policy can get waylaid by something that comes out of left field.
But speaking of boulders, we haven't asked and you haven't brought up geopolitical tensions. Is that not something that's high on your list now of risks out there?
Well, when you start seeing a conflict in the Middle East, you start thinking about oil prices, and it's very, familiar for those of us who lived through the 70s that an oil price spike has issues. Now, our economy is different than it was in the 70s and all that stuff, and we produce more. But yeah, you constantly monitor it, and I've been pleased that so far it hasn't really spilled into that part of the economy. But that's absolutely something to watch. When I talk about boulders, that's a classic example of a boulder.
You did well. 4 on 1, not bad. Tom Barkin, thank you very much.
Good to be
really
here.
Appreciate
Thank you,
coming and sharing your views and what you're hearing. The president of the Richmond Fed.